In my 20 years in banking, I've lived through so many crises. So you have that adaptability that you can bring.
You come from a sell side, right? And then you decide to jump into the buy side. You must have had to unlearn something and then relearn something else.
I think what you need to not unlearn is the capacity to structure and adapt to the forever moving market.
What trends are you following right now?
So we see the rise of like 3 mega trends.
40% of population in the UK in 2025 is not saving for the pension. Why do you think is that?
So there is plenty of statistics from the Department of Work and Pension, which are quite alarming.
Cécile Réterre, Head of Capital Markets at Phoenix Group. Explain to me in plain English, what is that you exactly do?
We're one of the largest long-term saving and retirement business in the UK. We have about like 300 billion of assets under administration and 12 million customers. And you may know us via one of our well-known brands, which is Standard Life. We're actually rebranding to Standard Life in March next year. And basically, there is 2 things that we do. For 50 billion, which is our balance sheet, we're basically paying our customer income at retirement. So very simple. So we're in the business of the annuity business or bulk purchase annuity in the UK. And what we do is that we acquire legacy defined benefit pension onto our balance sheet, and we invest on the back of it in assets, both public and private. And my team is responsible for the private side. And then the second thing that we do for the 250 billion, which is our policyholder money, we are basically helping our customers, the 12 million that I mentioned, saving up until retirement. And here it's quite exciting because we've signed the Mansion House Compact and the Mansion House Accord, that where basically, along with our peers, we commit to invest 10% of our customer savings into private markets, and that's across the full capital stack.
Well, definitely you have an impact on everyone's life every single day, that's for sure, with your work. Yes, you do, you definitely do, and we will get into that because I think there is some interesting numbers to discuss as well. But before we get into the product, tell me a bit more. I remember us discussing, and you come from a sell side, right? And then you decided to jump into the buy side. I'm sure in this transition, you must have had to unlearn something and then relearn something else. I mean, there is quite of a difference between the way the sell side operates and the buy side operates. What do you think was the main transition and learning in this journey?
I think what you need to not unlearn is the capacity to structure and adapt to the forever moving market. In my 20 years in banking, I've lived through so many crises, between like the Argentina restructuring, to the Eurozone crisis, COVID, the LDI crisis. So you have that adaptability that you can bring to the buy side. What you need to unlearn potentially is the speed of delivery of those projects. So for instance, at Phoenix Group, I need to be mindful when we invest in private markets in particular, that it's still fairly new, or let's say some asset classes or format are still quite new. For instance, structured credits or fund financing, they require basically different capital model or adaptability of existing capital model, and that takes a bit of time because we're obviously, whatever we do for our balance sheet tends to be heavily regulated. So the PRA behind needs to sign off on the adequacy of our capital model and making sure that it's prudent for the customers or for the shareholder.
You definitely come across as very knowledgeable and technical, of course, and I want to take the chance to ask you, can you take me through a bit more detail into the areas you look after doing, in your job, but also understand, you mentioned something again around corporate pensions, which I was surprised myself actually to hear that there is certain defined benefits, right, pensions still existing. Can you explain me a bit more about that?
So basically what we do when we acquire those legacy DB pension schemes is that we approach those corporate and financial that still are managing their legacy pension for their employers. And we're basically saying we're the experts in managing, pension, and we can, do you agree that we can do it potentially better than you? And usually they tend to say yes. Like for instance, a home builder company, they're more incentivized to build home than to manage legacy pension on their balance sheet. But also, you'd be surprised, but also banks or the large banks in the UK still are managing a large amount of those DB schemes and may not be motivated or incentivized to do it. So that's why they go into those bulk purchase annuity or buyout, where Phoenix Group and our peers were competing to win those mandates. It's quite competitive. Once it's onboarded onto our balance sheet, we have a full liability profile from, let's say, 0 to 50 years that we have to invest in assets. Usually half of it gets invested in gilt and investment grade public credit. Because we're on balance sheet, everything needs to be investment grade, so that's quite safe. And up to half of it will be invested in less liquid or private, so that's why my department is called private markets or alternative. And how we basically invest on the back of it is threefold. On one side, we rely on the private credit market, so it's anything that is corporate or financial risk. Have in mind like private placement or corporate loans or business development companies, BDCs, that are taking more and more space into our book as well. The second bucket is real assets. We're growing in commercial real estate lending, but also project infrastructure, as well as local authority financing. That is quite key in backing those big secular mega trends. And the last bucket is structured credit and alternative. It's quite new. When I joined, and because it's my bread and butter, I thought it would be interesting to have a division that sits across those first two, private credit and real assets, and enable us to lock format, whereas it's commercial insurance, securitization, wrapping, to be more at ease with that investment grade format.
When you look at the real estate and the project that you invest in, what trends are you following right now? Because of course we do see there is a lot of building going on, especially in countries like the GCC, the Middle East, but also I do see here in the UK they still keep going, right? What do you see in this space?
So we see the rise of like 3 mega trends. Obviously, we're patient capital, so we're a long-term investor. So we don't want to invest in any sector that bears too much cyclicality or that could be impacted down the line, even in 10 years, by rates move or by geopolitical instability. So we try and identify those big secular trends that are here to stay. And we have 3 of them that are quite big at the moment. One, demographic. So we're in the business of housing. Where we have clear underwriting expertise is on social and affordable housing. We have a multi-billion book in the UK, but we've also have exposure in the US and in Europe in that category. We know that risk very well, and currently we're trying to unlock more opportunities in Australia in that category. The second mega trend is energy. So whereas it's energy transition, transmission, and security, it's very big for us. We used to invest in core infrastructure, port, airport, student accommodation, transportation, utilities, and we still do that. But what we've seen is more and more exciting opportunities on the back of large capex needs for energy transition, grid connection, grid upgrade, electrification, renewables. So we're quite happy to have that diversification in the book. And the last trend is digitalization. So that's obviously a big one where, from data center securitization, but also cooling system or grid connection, whereas it's in the UK, in the US, in Europe, it's quite big in terms of needs.
And if we look at the third part that you described, so the alternative assets, kind of more exotic type of products,
Yep.
What areas are your interest there?
So here it's more a question of format. In structured credit, what we see that is quite interesting is asset-backed securities and asset-backed finance. Same, it's a world that belonged to bank for a long time, but where we can be a good complementary to our bank partners. So where the banks will be incentivized to do securitization and lend to, let's say, a private fund in a securitization format, let's say private CLO, for a duration of like 4 or 5 years, we would be very incentivized to do the same, but for a longer duration, because it will suit better that long-term annuity profile that I described. So we see a lot of opportunities in private CLO and in asset-backed finance to finance the real economy. So on the back of CRE loan, infra loan, but also potentially consumer and SMEs, where we would be potentially a bit more cautious there.
One thing that made me curious as well, we had, of course, a prep conversation, right? You mentioned a lot of times the role of partners, best-in-class managers.
Yep.
I mean, what do you mean? But also, how do you work with them? How do you select them? What's your criteria?
It's actually a great question, very topical. So when we're investing in private debt, we have a pure origination model that is completely hybrid, meaning we can go direct to the borrower and originate and execute the trades via bank's partner or broker or advisor, or we can decide to select an asset manager that will help us not only on the origination, but the monitoring of the transaction. And usually we leverage best-in-class asset manager in geographies where we have less presence. We're fully in the UK. So if we have to go, for instance, to commercial real estate lending in the US, I may want to partner with an asset manager that is on the ground. Similarly, we leverage asset management partner when we have a product that is potentially complex to monitor down the line or complex to align. For instance, social and affordable housing, there is like a long runway to align those trades between 6 months and 2 years with the local authorities in the UK, for instance. And we need partners to help us structure a quite complex transaction and help us monitor multi-tenant or multi or mixed use type of properties down the line. There is also the angle where on the back of the policyholder, which is that big book, here we don't have an hybrid origination model. What we want to do when we invest for our customer savings or the customer savings in private markets, we want to rely on LP plus co-invest. So here we basically select manager, alternative firm or long-standing traditional asset manager. And then across VC, private equity, infra equity, infra debt, real estate, and private credit, we select the best in class in their category, and we step in as LP into their funds, plus a bit of co-invest to dilute the fee, which can be expensive, or we can go SMA or fund of one.
What does best in class mean to you?
So best in class means a manager that first understands our culture, direction of travel, then performs to the best of their ability. So we tend to be very cautious in our due diligence around their track record, historical performance, but also volatility in talent, if they can retain, if they can properly have retention of their talent, or how they manage, the large portfolio manager or the key portfolio manager in-house. But there is also, I would say, qualitative criteria that we use, which are direction of travel and strategy and consistency, how they want to stick to their DNA. For instance, we've seen, the compression of spread in direct lending, and we've seen some direct lender going into, let's say, instead of focusing on senior lending, they went into mezzanine lending without the proper track record. That, for us, is not a sign of like a best-in-class manager necessarily. The last one is the cultural fit and how basically we will work together, extreme transparency and communication, and usually the base or the good fundamental for a good relationship.
Touching on the relationship, our relationship is always made of two parties, right? So why should they work with you? And that's the question. Well, let's turn the tables a little bit.
On that front, we're becoming, and I think I talk for the UK crew or the UK insurance crew, quite relevant for private markets. And I think the catalyst was that Mansion House Compact that I mentioned, that we signed 2 years ago with a few peers, where initially it was us committing to invest 5% of our customer saving into unlisted equity. Why unlisted equity, which is private equity and VC basically? It was because it was a swear word in the UK pension and insurance world. And it has been like a catalyst of like suddenly the UK insurance crew being relevant in that market. And the second version that we signed like I think 11 weeks ago is now doubling, so it's 10% of our customer saving, but into the wider private market. So why working with Phoenix? Because we will have scale and because we need partners. My team, we're like 25 portfolio manager or investment manager. We need to diversify away from the UK. We've started and we've been quite successful at it, but we need those partners at scale. We're positive about what we're trying to achieve as an institution. We're purpose-led. We want to do good and invest into critical and essential assets or infrastructure, whereas it's in the UK or internationally, but we indirectly want to help our customers save more for retirement, and that is what we're trying to achieve down the line as an institution.
You mentioned customers. There is a number that stuck to my head since you mentioned it, which is 40% of population in the UK in 2025 is not saving for the pension, or at least they're not saving enough. Can you tell me more about that? But also, why do you think is that, and what can you advise?
So there is plenty of statistics from the Department of Work and Pension, which are quite alarming. 40% of like working age adults are under saving for their pension. There is another statistics that is from 2025 survey as well, where 91% of people in the UK reaching retirement will not have enough to have a comfortable living, meaning not going to the restaurants, not going on vacation when they want. So that's quite tricky. And what we've realized is that the government, despite all efforts to address that issue and push customers or to invest more or to save more for their retirement, will not be the only solution for the problem. So on our side, on the insurance side, we have the ability to invest and boost returns. So that's why we feel like quite motivated by in having private market solve a tiny bit of that issue in delivering enhanced return well above the index and allowing potentially younger customers to save more for retirement. Where we think it's quite important to invest in private market is when you're younger. So if you're in your 30s and 40s, maybe the proportion that you should put into private market should be closer to 20-30%. When you're closer to retirement, you may want to have a lower proportion. So why people are not saving for retirement? There is a lot of reason. There is the cost of housing in the UK that have rise. There is like the uncertainty of the volatile political cycle as well that is not potentially incentivized the customers to take care of their retirement. There is the fact that people are going to retirement a bit older now, so they think they can plan later. And then there is the also a part of the economy, whereas it's on the black market, on the startup that do not rely on large corporate pension schemes. The contractor, the independent professions, where you have to be actively planning for your retirement, and it's not in the culture to do that.
Do you think we're still paying the price of 2009 on this as well? And there is still that kind of mistrust towards the institutional investor from the retail customer?
When it comes to retirement, there is still like a bit of lack of education of why it's so important to save and how much you need to save up until retirement. There is that, if you're below that 300K or 100K for the rest of your year when you retire, if you're 65 and now we're with the aging population, but also with the fact that people are dying later, you need to plan for 20, 30 years even. So that's why the pot that you have to get in mind is much bigger than what it used to be. And I think it's not yet in the philosophy. Our Canadian peers and Australian peers have done it quite efficiently. They don't have a pot problem. The pot is big enough. They have the luxury problem of like overspending at retirement. But what they've done is they're investing way more in private markets than here in the UK. In Canada, it's about 15%. In Australia, it's averaging close to 19% on average. And that has boosted massively their return. They started 10 years ago. So we're a bit late in the process, but we're trying to catch up as much as possible.
As we head towards the conclusion, can I have like a macro view from you in terms of where the private markets are going in comparison with the world we're living today? I mean, a lot of uncertainty, rates moving around. What do you see happening in the next few years?
So it's quite interesting, and we've seen like spike of volatility, especially this year in March, April, for instance. Where we would invest in private market is that it needs to make sense. When you invest in privates, it's less liquid or it's more complex. So there is an element of illiquidity premium or complexity premium. And for us, the paramount principle that we will respect is relative value. So if there is not enough relative value between our investment in private credit, let's say, and public credit, there is no need for us to invest there. A good example is in Q1 this year, with a dislocation, gilt was even more attractive than public credit and private credit together. And we basically were muted on the placement space because it was not making sense from an illiquidity perspective. Where we focused our area at that time was on real assets, where there was still like great opportunity in infrastructure or in commercial real estate lending that we could grab in prime location. Here again, back to the credit fundamental, it's very important to build expertise. And that's why you have that trend of a lot of bankers like me going into the insurance scene to build that expertise and make sure that we are assessing any credit fundamental and any underlying risk that we're taking when we're investing.
And this expertise brings credibility, and credibility means reassurance, and probably that's also one of the things that we want to see as retail customers to this type of product, right? Because you want to make sure the person that is managing your future is going to do it right.
Totally. And this is why, for instance, whereas it's on the annuity side for DB, where I think every year we see 400 to 500 trade opportunity that we assess in detail, and we have an execution rate of less than 3%. Similarly, on the policyholder side, when we select a manager, you would not see us look at nascent manager. Potentially, they will have a great track record later on, but we will not be in the betting market.
I have a little game for you, just to terminate.
Yeah.
I will ask you either or, so you this or that, and you're gonna tell me which one you prefer and maybe why. So I have infrastructure debt or real estate debt.
My answer is both. Why? Because we've merged our department in infra and real estate together for that reason. There is like a collusion between what is infrastructure and what is real estate. The best example, data center. Is that a real estate when you look at the development and of the building, or is that a project infrastructure on the back of the energy transition?
In the next 5 years, UK or overseas markets?
UK core market, but obviously we need diversification, so international for sure.
Direct mandates or managers of managers for DC?
Fund of fund manager, when you're small, which we are small, we have small allocation as of today. When we will have scale, definitely direct manager and SMA fund of one.
Cécile, thank you very much. It was very interesting, and thanks for joining us today.
Thank you very much. Thanks, Andrea.